Hey guys, this is Andrew Weber with mycreditcounselor.net. I'm a certified student loan counselor and a private student loan negotiator. Today I want to talk about the biggest misconception that I see with private student loan settlement. And that really revolves around the mindset that some people have when they want to settle their loans but they don't have the funds to do so. So the biggest misconception that we actually see is when someone wants to settle their loan, cut their balance in half by 40 or 50% or more, but they want to pay that settlement over a long period of time, like a normal loan term, maybe 5 to 10 years with just normal monthly payments of a reasonable amount. It would be really nice if lenders did that, but unfortunately that's just not how settlement works. So the best way to settle a private student loan, I always tell people this, is with a lump sum. That's for two reasons. One, you're always going to get a better deal. The lender is going to have more of an incentive to take a lump sum, and if you're hiring me to negotiate for you, we're going to be able to get the lowest possible settlement that we can get for the amount of time that loan has been in default and any other factors that are contributing to that. The other way to settle is with a structured settlement, and kind of going back to what I had said in the beginning, a structured settlement is not something where you slash the balance in half and pay it over 10 or 20 years. And yes, it'd be really great if lenders did that, but the type of lenders that we're dealing with are very ruthless companies, and they're going to do what's in their best interest. They're going to try to maximize their returns on their losses to an extent, but they're not going to go out of their way to be flexible with borrowers, unfortunately. So a structured settlement really is a down payment, a significant down payment, followed by payments over a short period of time. We're looking at 6 to 24 months max. So the down payment for a structured settlement, in my opinion, should always be at least a third of the settlement amount. And the reason for that is you want to incentivize the lender to go for the settlement instead of trying to get you back onto a payment plan on the full balance. And of course, when you have a defaulted private student loan and you're making payments on that, it is not going to show as paid as agreed on your credit report, unfortunately. That charge-off is pretty much a non-reversible thing. So to anyone looking at your credit report, even if you're making payments on a defaulted private loan, it's going to show as a defaulted private loan, and it's not going to show the payments. There may be a way to dispute that with the credit bureaus. I've not heard of anyone doing that. That's something for the credit repair and credit dispute experts maybe to look into. So when you have a defaulted private student loan, you do want to settle it or pay it off, or else it's going to drag your credit down and hold it there until it is paid off in full. So if you're making payments over time, that can take a very long time until you actually have paid that loan off. So a structured settlement is a significant down payment, followed by the remaining balance on the settlement paid out over 6 to 24 months total. So your first payment is the down payment. So if you have a 24-month settlement term, payment number 1 is the down payment. The remaining balance on that settlement is divided by 23 and paid over time. And this is where it gets really tricky. So a structured settlement can be more flexible. It's going to be a higher percentage. It depends on the lender as far as whether that's going to be a significantly higher percentage than a lump sum, or maybe you're talking 5 to 10% higher than a lump sum and still something that's a good deal. So when you do a down payment on a structured settlement, that tells the lender that here's a big chunk of money towards the loan, and that gives them the incentive to take the settlement versus just getting you back onto a payment plan. So a structured settlement does give you more flexibility over that period of time than a lump sum settlement. And I realize not a lot of people are in a position to just put down a big chunk of money for a lump sum settlement. I talk to people every week that, they're frustrated, and I understand their frustration that, hey, we just can't afford to do a settlement like this. There are some people that it's a good fit for, and typically that's going to come from either saving up over time, borrowing from a friend or family member, the sale of an asset or a business, retirement accounts, even home equity lines of credit can be used to fund settlements. I do recommend doing a lump sum settlement if you can, for the reasons I mentioned earlier. 1, you're going to get a better deal. 2, you don't have the risk of a structured settlement. And a structured settlement, the risk where that comes in is if you miss one payment. If you miss a single payment on a 24-month term, the entire amount that you've already paid goes to the full balance and that settlement is voided. And even worse, if you enter into a structured settlement with a law firm after they file a suit against you for a stipulated agreement, then they're going to get a judgment if you miss that payment. They're going to automatically get a judgment if you miss one payment on the structured settlement. So structured settlements can be more flexible, however they are also more risky. So going back to the big misconception that we see is that these structured settlements can be done with just basically a renegotiated payment plan over time, over 5 to 10 years with no down payment. Just, hey, let's do 50%, I'll pay you $200 a month for the next 12 years. Unfortunately, these lenders just don't work that way. The lenders that we're negotiating with are ruthless entities. They're very, very aggressive with borrowers, and they're well known for going after people, going after co-signers. Navient, the largest private student loan lender out there, and also a large federal loan servicer, they're in the news all the time, and not for the right reasons. And I'm sure many of you have heard about that over the last several years, and even before that. When Navient split off from Sallie Mae in 2014, Sallie Mae already had a very bad track record, lots of regulatory investigations, and a bad reputation as far as how they deal with borrowers. And Navient is a very similar company to Sallie Mae. And actually, the CEO of Sallie Mae at the time, Jack Raimondi, he is now the CEO of Navient. So those two companies are very closely related. Their practices can be a little different these days. But as far as their track record and how they deal with borrowers, they've had kind of the same reputation since before they split into two companies. Another large private student loan lender, many of you are probably familiar with, the National Collegiate Loan Trust. Probably the most aggressive and most litigious lender out there. They've kind of slowed down some of their litigation in the last year or so, and now they're taking more of what we would consider a hardball approach as far as negotiations, and they're dragging it out over a period of time before they get to a lawsuit. But they will get to a lawsuit on a significant size account before anything, if nothing else is done. So these lenders are extremely aggressive. Right now, as I speak, Navient is putting a lien on someone's dad's house. They're suing somebody's grandma, their cosigner. They're garnishing people's wages on a very large scale. And National Collegiate Trust is doing the same thing. So it's a very adversarial process when we're dealing with these lenders. It's not like you call in and just renegotiate a payment plan. That's not how settlement negotiation works. It's very adversarial, and it can be very difficult if it's something that you've not done before, or even if you have. It's a different feeling when you're negotiating on your own accounts rather than having someone with an objective viewpoint who can keep their emotions out of it. And I say that from personal experience as well. When I've had my own accounts go into default, whether it's a credit card or something like that, and I've negotiated on it, it's a different feeling for me. I have to make sure my emotions are not getting the best of me, even though I've been a negotiator for 10 years in the debt world. So it's a very steep incline to try to climb up by yourself if you've not done this before, and trying to call up the lenders and saying, hey, I want to cut my balance in half. Will you take a payment every month for the next 12 years? They're unfortunately just not going to do that. That's the way these guys operate. It is a very adversarial process. So structured settlement is a down payment and a short period of time, a short payment term after that to pay off that settlement. There is risk involved. There is probably going to be a higher settlement than if you did a lump sum. But it can make sense for people, and we do negotiate those kinds of settlements regularly. Even if a lender goes past 24 months, which is kind of the usual cutoff that we see, occasionally I'll see a National Collegiate Loan Trust offer if I'm negotiating where they'll say, hey, we'll take this over 4 or 5 years. And even if they're going to accept that, which is rare, I don't advise my clients to do that because you don't know what's going to happen in 2 or 3 years. You really want to do the shortest structured settlement term that you possibly can to reduce the amount of risk that you're taking on, because if you lose your job in 2 or 3 years and you can't make these payments, then you're in basically the worst case scenario for a structured settlement. You've paid all this money so far, it's all gone back to the lender for the full balance, the settlement's off, and they're going to continue to pursue collection if you miss one payment on a structured term. So that's why I recommend doing no more than 6 to 24 months, even if the lender will go longer, which usually they don't. With the banks like Wells Fargo, There's still some Chase private student loans floating around. They don't originate private loans anymore. Wells Fargo, Discover, Chase, they're not going to go more than usually 3 to 6 months on a structured settlement. So if you got a pretty big amount and you're putting down even a third of the settlement amount as a down payment, and you divide the rest of that by 2 months, 3 months, 5 months, even over a 12-month total term, your payments are probably going to be pretty high on a structured settlement if it's a large balance. And that's another reason why structured settlements are very difficult for people, especially when you get to these higher balances over 6 figures, $100,000, $150,000, even a $50,000 loan can be tough to settle with a structured settlement unless you have significant discretionary income to put towards that. But by far the biggest misconception that we see is people that want to settle their loan with the best of intentions. They want to do something about it. They want to get it paid off. They want to settle it, but they want to do it with low payments over a long period of time. The lender's just not going to go for it. So that's what I want to talk about today. We're going to have some more videos coming up soon going over different topics about different lenders and different issues we come across when we're negotiating private student loan settlements. If you're interested in settling your private student loans and hiring a professional to do that, visit my website today, mycreditcounselor.net. Give us a phone call, fill out our evaluation form on the website, and we'd be happy to work with you. And we'll talk to you guys soon.